today's lecture meeting on key learnings from NFRA and QRB reports. I think first of all, I would like to thank Nasser for accepting today's invite. Initially, it was Khushru sir who was planning to take up the lecture, but due to some urgent work commitments, he couldn't take it up, and he has recommended from his colleague Nasser to take up. So, thanks a lot, Nasser, for agreeing to speak on a very short notice. And of course, Nasser is also having a great background coming from Walker Chandiok and being a large one of accounting and auditing firms has a great exposure to an auditing matters, and he has also very keenly watched and interacted with the regulators, especially NFRA, and he has a very good experience about that expectation from based on his interaction with NFRA as to what are the expectation of NFRA from an auditing community. I would also like to introduce Nasser, who has agreed to speak. I think he's very experienced speaker. He has worked in initially earlier with Deloitte Haskins and Sells for almost 6 years. Then as a senior manager in Haribhakti and Company in various audit practice, and from January 2020 he's working with Walker Chandiok and Ross as and Company LLP as an executive director in quality and risk management group. I think participants would hugely benefit from his experience, and we welcome him. And once again, thanks for agreeing on a very short notice of almost not even a day to speak on this very important topic. I would now request Nasser to take up this topic and share his thoughts on this subject.
Uh, Thank you, Tejas and Yogesh bhai, for inviting me. First of all, am I audible?
Yes, yes, yes.
Okay. So, thank you for inviting me. This topic is day in, day out for me. So, I mean, though it's only a one-day thing, I just needed to compile the presentation, but otherwise, it's a day-to-day business as usual for me. So, not a much effort, so to say, on the preparation side of it. Having said so, I think let's start with the topic. Key learnings from NFRA reports and orders. Just to set the context here is see, there are increased watch out from ICAI as well as NAFRA, especially when after the NAFRA became more active. So what we would discuss here would be in this session would be certain observations made by NAFRA and QRB, of course. Though QRB reports are not a publicly available document, but QRB comes out with an annual report. So we will be discussing the last annual report for 22-23, which they recently came out with. And NAFRA reports and orders and audit quality reports by NAFRA are publicly available on the website, and there are increased number, so to say, over past year or so. So we'll basically discuss the findings, observations of both NAFRA as well as QRB. We'll not go into the arguments which firms might have put forth, challenging those findings, or those findings might be getting challenged in some court of law or forums. But what our target is to derive learning from all these observations so as to help us in going forward for our profession as such. So basically, the regulators, while conducting their review, they have the benefit of hindsight. Hindsight in the sense that if something has gone wrong in that particular audit client, they have that hindsight of or the information of that wrongdoing. However, when auditor actually audited that, they got only what sometimes for listed audit clients the timelines are quite stringent, and so uh, there might be a possibility that auditors did not get proper time, but that's not an excuse which regulator will buy. But yes, in all these reviews, regulators do have benefit of hindsight, which as an auditor we don't have, but that's the rule of the game. In some cases, even there were instances where NAFRA has not got the audit file at all. In the sense, uh, when requested for submission of audit documentation, no file were submitted by the auditing firm, and NAFRA has proceeded there that there is no audit documentation and pronounced their ruling. So there were cases like those as well. Uh, Again, the bottom line here is, and where NAFRA, from my practical experience, is differs from their international counterpart, which we can say is PCOB, is PCOB sometimes, as available in public domain, considers those uh, documents or audit evidences which are available with the auditor, if auditor is able to prove that those were available at that point in time before the date of issuance of audit report. If auditor is able to prove that he or she was in possession of those documents at that point in time, PCOB sometimes allow that as an audit evidence. However, NAFRA's approach till date, having gone through one cycle of NAFRA's review, it has been that whatever is not documented is not done. So WND principle, as we used to teach in our articleship days, that work not done, work not documented means work not done. So NAFRA follows that principle. So what we have is only for audit procedure, we have time till the date of our report release, and for documentation we have time till the date of our archival date. And there are matters which are and observations which have been observed by NAFRA in this regard as well. So WND principle is what we need to abide by, so to say, when it comes to NAFRA. So I'll share my screen now, and let me know once it's visible. Uh, can anyone confirm whether my screen is visible?
It's visible.
Yeah, thank you. So what we will be covering here is an overview, regulatory jurisdiction, what powers NAFRA has got, because these powers are wider than ICI's powers or the QRB's powers, of course. Findings in NAFRA orders and possible indicators, what did went wrong in those audits per se. The NAFRA inspections, this is different from NAFRA orders. NAFRA orders are the individual files or clients which are selected by NAFRA and done a detailed review of those audit file documentation. Whereas NAFRA inspection is the first time when NAFRA inspected 5 large audit firms. And recently, NAFRA came out with a final report on those firms' quality as well as engagement specific findings. So we'll discuss and touch upon those findings as well. And then we'll discuss on the QRB, quality review boards, process, statistics, and observations. And finally, we'll discuss what all opportunities lies ahead with us to improve on taking learning from all these findings. So hopefully you will find this useful, this session, and we'll jump onto the session to start. So first of all, let me start with a very basic thing, that is, what does quality mean? So as we all know, and this saying is quite an old one and famous one, that quality means doing right when no one is looking to us. However, now the situation has changed, and in addition to ICI as a regulator, because of some doings or some not doings, we have one more and stricter regulator, I might say, in place. So now at least there are two regulators who is looking, and therefore the more thrust is to be provided on the quality piece. Basically, all these findings and observation, if we see one learning, if we take it, is if we do the fundamental things right, there is no problem at all. No standard on auditing has undergone a substantial change. Similarly, no accounting standard has undergone a substantial change. Only a regulator has come in, and therefore there is a sense of urgency of uh, improvement in quality is felt. But it was nevertheless there. This requirement was always there. System of quality control, we all know SQC1. These are the components of quality uh, quality control. It starts with leadership responsibility. A tone at the top has to be in the right direction, and then it will percolate down to other components of SQC1. Uh, how this quality cycle runs is a typical manufacturing process also is this way only. So if we see input, process, output, monitoring, and remediation. So even the audit quality runs through this quality. For example, in case of a professional service firm, let's take an example of any audit firm. So reputation of good quality leadership will attract a good quality client. A good quality client will attract good quality personnel, and definitely a good quality client plus personnel will give a quality audit or quality output, or that is the quality of good audit report. And this will in a way uh, uh, generate quality revenue for the firm, and this circle will continue and the firm will grow. So it all starts with good quality management. The tone at the top has to be perfect. It should not only be in their words, but in their day-to-day life also. Leadership of the firm should demonstrate that they live quality. Having said so, let us now see what all or which all companies are covered by NAFRA. So Section 32 uh, uh, and the NAFRA rules describe which all entities are covered under the NAFRA rules. So first and foremost is listed companies and body corporate. Now there is, though this appears to be a simple one, but this listed company would also include uh, private debt listed company as well. So this listed means any security, if it is listed, it will get covered by NAFRA, be it public or private. Second one is unlisted companies, but it should be public. So unlisted public companies with paid up capital or borrowings, debentures, deposits, all inclusive. So if it is paid up capital more than 500 crores, it gets covered. If borrowing, loans, deposits cumulatively crosses 500 CR, that company that's covered. Or if turnover is more than 1000 CR, that entity that's covered. Now, these thresholds are difficult to apply in between the year. For example, let's say borrowing crosses 500 CR during the year, and it again reaches below 500 CR at the end of the year. And anyway, it is difficult to track these thresholds throughout the year. So it's a settled principle that all these thresholds, paid up capital, loans that is borrowing, debentures, deposits taken together, and turnover needs to be considered as at the previous year end, 31st March of the previous year. Uh, these thresholds are to be considered at a standalone level and not on a consolidation basis. For example, company has a turnover of 400 crore and a subsidiary has turnover of 600 crore, then no, and other, of course, other criteria are not met, then both of these entities are not covered by NAFRA, uh, because though the total consolidated turnover is more than 1,000 crore, but individually it is less than 1,000 crore. Moving ahead, banking companies, insurance companies, companies which are in a business of generation or supply of electricity are covered. Any company or body corporate on a reference made to the authority uh, by the central government in the public interest. So currently there are none. Central government has not referred any company or body corporate in public interest as yet. Companies, certain specific foreign subsidiaries and associate of Indian companies. This is an interesting one. What it says is, if a body corporate which is incorporated or registered outside India, which is a subsidiary or associate of any company or body corporate we have covered in this A to D, A, B, C, D. And that foreign body corporates turnover or net worth exceeds 20% of the consolidated turnover or the net worth, then that body corporate is also covered under NAFRA. Having discussed this A, B, C, D, and E, if an entity is covered by NAFRA, once it will and let's say next year that criteria does not meet anymore. For example, if there was a paid up capital and it crossed 600 cr and there was some buyback, and because of which paid up capital reduced to 450 cr, so that company once covered will continue to be covered for more 3 years, even though after it ceases to fulfill the criteria mentioned above. So this is an important point to note, which many companies and auditors forget. That is Rule 3, Sub-Rule 4 of the NAFRA rules. Having discussed what all is covered by NAFRA, let's see what all remains with QRB. So earlier QRB's regime or the coverage was the entire gamut of all audit clients, but after NAFRA's uh, coming into picture, QRB's you know gamut has been reduced, so they can only review now those entities which are not covered under the NAFRA rules which we discussed. So, or NAFRA can refer any review to QRB, those review it can consider. So now QRB, uh, the main piece remains with QRB is large private clients and those public companies which are not covered under the NAFRA rules. Here, one thing we need to consider is, though it says that in this previous slide that unlisted public companies with paid up capital and all, here we need to consider if there are any private limited companies which are subsidiary of public companies, that is deemed public company, those also will get covered, and we need to apply this threshold test on those private limited companies as well. Now, hopefully, we are clear which all audit clients can be picked up by NAFRA and which all audit clients can be picked up by QRB. Having discussed this, let's see what powers NAFRA has got. So, NAFRA is basically a civil court. So, it can, ask for production of books of accounts and audit files. Generally, from my experience, what first information they would ask is, give this particular engagement clients or this particular audit clients audit file, and that audit file include hard copy physical files as well as the soft documentation. They prefer that we give entire audit file in a PDF form or Word or Excel. So if there is any software which is being used, we need to convert those into PDF files. And if there are hard copy physical files, that also they expect us to scan and give it to them. So they provide a link and with a password shared, and on that uh, link we need to upload the file. There is no space restrictions. However large the audit file is, it can be uploaded. So generally what they asked is the audit file, hard and soft both, and they would ask the SQC1 document and policies and procedures regarding those. So basically they are looking after whenever they opt for any review of a file, they will see first whether the quality control policies and procedure at the firm level are proper or not, and then they go to the engagement level file and documentation and so on and so forth. So basically they have got powers for production of books of accounts. They can also summon and enforce attendance, inspection. They can do issuing commissions for examination. This is a legal term. Issuing commissions means conducting in-depth investigation. So basically civil court powers are vested with NAFRA. They can investigate into the matters of professional conduct, uh, basically, and then they can pass an order. Order can be of two types, and we can see, and we'll see in the slides ahead what all kinds of orders they have passed as on date. So if we see, orders are two types: penalty and debarment. There is uh, uh, and in between, so and or, so there can be only penalty or debarment or both. So penalty, luckily, unlike the existing ICI rule, they have linked with the audit fees. So in case the misconduct is identified for an individual, the penalty amount is minimum 1 lakh, and it can go up to 5 times the audit fee. And if it is if the misconduct is identified against the firm, it can be 5 lakh or 10 times the audit fees. And debarment can be for 6 months to 10 years. Minimum debarment is 6 months and maximum debarment is 10 years. When we say debarment, it means they can debar uh, a firm or a partner of a firm from conducting any work under the Companies Act. Now that can be, debarment can be for conducting any statutory audit, conducting any internal audit, or doing any valuation work, because these three are defined under the Companies Act. So they have power to bar the firm and or partner of the firm from conducting all these three things: audit, internal audit, or valuation as well. Having said so, unlike ICAI existing mechanism, the actions can be taken only against the partner of the firm, vis-a-vis NAFRA powers, where the action can be taken against the firm as well. And we are aware one of the case is going on where firm is contesting against the debarment. Moving ahead, so this will give us a feel or the idea how NAFRA is suddenly become active in past, uh, let's say, 18, 19 months. If we see, this is 64 cases of, uh, not 64, 74 cases in all. And out of 74, 64 cases have been since 2023. So before that, there was only 9, 10 cases of debarment or penalty, etc. Uh, but the majority of these has come during last in 23 and 24. And out of these 64, total 74, there were 8 instances where only uh, penalty was levied. And there were other cases like 66 cases, there were penalty plus debarment. And how that debarment varied or penalty imposed. So if we see, So majority of the cases, like 31, 32 cases, there was penalty of to the tune of 1 lakh, and in one instance it reached to 2 crore as well. So these were the amount of penalties across these 74 cases. And debarment, in case of the 66, debarment was majorly for 1 year, but there were debarments of considerable number, more than 18, in case of where the debarment of was for 5 years, and there were 6 cases where the debarment for was for 10 years. So it's a quite a large number in case of debarment which has been levied. Uh, though this number is alarming and indicates and hints how NFRA is going to work in future. Two observations in these numbers. First is, if we see the amount of penalty, there appears to be a mismatch. In certain cases, for a similar offences, uh, penalty is quite less, whereas in other cases there is a penalty plus debarment and penalties of significant amount. So might be there will be some guidance around this on how NFRA decides on actually the penalty and or debarment decisions. There might be some guidance in future. As of now, there is nothing. Out of these 74 cases, 25 cases belong to one particular main case, one particular client. Uh, there, it was an interesting case where, and very famous case, 250 branch were audited by 33 branch auditors. And we'll discuss about that instance in our next slide. But it's a so out of the 74, 25 out of 33 branch auditors, orders have already been passed against 25 branch auditors. So this 74 includes 25 orders against in case of one particular client or one particular company only. So though number have increased, but 25 pertains to one client only. So now we come to the main topic of our discussion, that is what were the findings, and what I will cover is the possible indicators uh, as to why we feel or why we believe that those findings would have taken place. Again, it's a subjective thing, but we need to find the learning out of that finding. We need to link it to how we could have avoided that in our client situation. So for the first set of findings, there was a client and engagement acceptance related observation. Here the case was the audit was accepted without valid authorization, and scope of service of branch auditor decided by statutory auditor and management only. Now, had it been a physical session, I would have asked, do anyone know which provision of the companies that deal with appointment of branch audit? Do we have? I mean, uh, people can write in chat, right? Yogesh bhai?
Yes, I must say.
Okay. So anyone take a wild guess as to which section of the companies that cover appointment or work in relation to branch audit? I'll wait for 20 seconds maybe. Sorry. Yeah.
Somebody
So,
raised section 143. Somebody is mentioned.
Yes. So Ankit Parekh has written section 143, and it's a correct answer. So 143 subsection 8 states that if a company has a branch, then that branch needs to be audited by the auditor appointed by the company, or auditor which qualifies to be the auditor under the Companies Act, fulfilling the criteria given under Section 141. That auditor can do the audit of that particular branch, and that auditor needs to submit his or her report to the main auditor. And there is a guidance given for foreign branches as well, so and so forth. So the case here, what I am referring to is, there were 250 branches, there were 33 branch auditors. Out of 33, for 25 branch auditors, the orders are already passed. And for that 25 branch auditors, the appointment was not done at the AGM at all. The AGM resolution only appointed the central statutory auditor, main auditor. It didn't specify the appointment of branch auditors. So first of all, the appointment itself was invalid. Now, some branch auditors put forth the argument that since the appointment letter which had come to them was signed by a senior person, or the engagement letter was signed by a senior person, and we learned a rule of law, doctrine of indoor management. So some of the branch auditors put forth that argument, because of doctrine of indoor management, which means that as an outsider, we should assume that the company would have complied with the provisions as was required from them, and the proof of proving that those procedures were complied doesn't come on us. But that was not uh, you know hold true by the NAFRA, and what they said was, this is, even our consent letters, interestingly, states that at the time of appointment, under 139, the consent letter which we give states that our appointment, if made, will be in accordance with the provisions of the Companies Act. And there is a stand in Volume 2 Code of Ethics. In CA regulation, there is a misconduct specified that if CA accepts appointment which is not as per section of the provisions of the Companies Act, then that CA, that member would be guilty of professional misconduct. So in this case also, all those branch auditors were held guilty of professional misconduct for accepting appointment without compliance of provisions of Companies Act, and also for gross negligence on this part. So care learning here, what we should be doing, taking care is, at the time, in case we are doing any branch audit, or where we are central statutory auditors and there are branch auditors involved, uh, we should ensure that the appointment by, maybe if it's a normal appointment by members in the EGM, if it is appointment under casual vacancy by the board of directors, the appointment does mention appointment of branch auditors as well, in addition to appointment of central statutory auditors. A simple step, but it has resulted into misconduct for series of branch auditors. Again, the case here was, even the scope of work was decided by the company in consultation with the statutory auditors, the central statutory auditors. So, for example, uh, actually the scope was to be governed by the provisions of the Companies Act, but here the scope was decided by the company in consultation with statutory auditors. So there was non-compliance there as well, and because of which the branch auditors were held guilty for negligence, gross negligence on this part. If we see these possible indicators, what would have gone wrong? So basically, tone at the top was not aligned in this observation. Lack of understanding of the requirement of the provisions of the Companies Act and Code of Ethics. Lack of policies and procedures on client acceptance, approval, agreeing on the terms of engagement. Engagement letter needs to be signed by a person who is authorized to sign those. It cannot be by finance director, if he or she is not authorized by the board of director to execute the engagement letter. Generally, when members or board of directors appoint auditors, they have to fix remuneration as well as nominate. If the remuneration is not getting fixed, then they nominate certain people with designation or name that they will agree the fees and the scope of work with the auditors. So those authorization needs to be traced back to the appointment resolutions by members or board of directors, as the case may be. So lack of sufficient resources to implement policies and procedures. This is mainly because at the time of appointment, the eye to detail needs to be there, and for those, there has to be set policies and procedures in place. People side, if we see, so if you see this possible indicator, what I have jotted down is basically linked with the components of SQC1. Maybe tone at the top will go with the leadership responsibility. Client acceptance will go in the client acceptance piece, people will go in human resource and all. So these possible indicators are linking this non-compliance with uh, the components of SQC1, where the concerned firm should have paid more attention to. People side, if we see, there might be unfit hires. Reward and recognition does not consider quality. Many a times, people are appraised for the business they handle or the audit fees they generate, and less of recognition is given on the quality piece, that how much they complied with the uh, relevant professional standards, and people are not held accountable in case there is any non-compliance. There is a tendency to forgive, but for certain instances there is the people should get be accountable and be sanctioned, and be publicize that sanction, so that people at large at the firm know that there are implications and action taken for any of the non-compliances. So in my future slides, this right-hand side piece, possible indicators might remain same with certain modifications or tweaks. We'll discuss only those tweaks in detail in the to avoid the duplication. Uh, yes. So far so good. This why we go ahead, right? I am presuming yes. Voice is feeble, Yogesh. Your voice is feeble, but we are going ahead. Yeah, I'm taking it as yes. Next piece of observation can be bucketed into the ethical requirement piece. Approval under section 144 not taken. Very, very common observation in many of the orders. Here, the two types of non-compliances are observed. One, many a times firms fail to identify the other firm which falls under the category of the firm. So in section 144, there are two explanations in case of firm and in case of proprietorship firm, proprietorship and partnership firm. So in case of partnership firm, there are certain other firms which gets included in the definition of the firm. So at some places, some firms fail to identify the entities which are covered under the definition of firm, and therefore any non-audit service, suppose a firm has an advisory arm, and that advisory arm is controlled or significantly influenced by the partners of the CA firm, then that advisory arm is also covered by section 144, and any non-audit service which is provided by that advisory arm is covered by 144, and therefore prior approval of board or audit committee is required. Another important thing, though section is not very clear, but it is a settled principle both at ICI and NFRA level that this approval is a prior approval. Again, uh, a settled principle that it says that approval from board or audit committee as the case may be. So here the approval, whenever there is an audit committee at the client, then the approval has to be of the audit committee. Approval of the board will not be sufficient. So when the meaning of board or audit committee as the case may be, the approval, wherever there is audit committee, approval has to be from audit committee only. Another piece is approval is required when a non-audit is proposed for parent as well as subsidiary of the audit client. Not only, so people do forget for taking approval for the other entities, and these are required for all permitted services. So it's not like for non-permitted services these approvals are required. Non-permitted services are not permitted any which ways. There are certain cases or instances where prohibited non-audit services were provided, maybe to holding company, subsidiary company, or even to the client as well. These were the initial reports where the large firms were involved, where there are subjectivity involved, where a firm may believe that those were permitted services, but NAFRA believed those are not permitted services, mainly falling into those management services bucket where the arguments are still going on. But my personal view is, when there is doubt, it is better to err on the right side of the law and avoid those services, because regulators are day by day becoming non-negotiable on this piece at least. Not evaluated all relationships. So apart from non-audit services, there are other relationships which needs to be taken care of. None of the partner should have any shares, or relative should have any shares exceeding face value of 1 lakh. Loans, borrowings, guarantees, a relative being the KMP of that particular client. So those all checks and balance mechanism was not present at the firm level, and therefore those observations also came in. Then one important piece is team members not rotated. So there is one full 4 or 5 page section on rotation of senior personnel in volume 1 of Code of Ethics. Again, it relies mainly on avoiding the familiarity threat. And it says that generally for public interest entities, which includes listed entities for sure, the team member generally would include engagement partner, EQCR partner, any other partner involved in that audit, and in most of the cases, audit manager as well. Those team members needs to be rotated on a periodic basis. Now, this periodic basis can be driven by multiple factors. Section 139 of the Act also states where a member appoint auditor. Generally, a proprietorship is appointed for 5 years, firm is appointed for 2 terms of 5 years, but the right is given to member, or the option is given to the member to specify the period over which they want engagement partner or the team to be rotated. So this rotation can be driven by members' resolution, can be driven by any other regulator. For example, RBI in certain cases mandates a rotation of audit partner over 3-year period. And Code of Ethics specifies that if there is no specific provision for rotation in any other regulation or by members, generally over a 7-year period, team members should be rotated. So in one of the case, again a large firm, which was a RBI covered entity, where the rotation requirement was for a partner over 3 years, and there the partner continued for more than 5 years, and therefore these observation came in. So basically, at a firm level, we should have checks and balances in place. Firstly, to identify that none of the partner, let's take an example of financial interest. If we want to be firm that none of the partner is holding any security in any of our audit client, and the coverage is very vast. It should be, they should not be holding any in the audit client, its holding company, subsidiary, associates, joint venture, so and so forth. So the firm firstly should have the database of all the clients and the related entities, and then provide that list to client, to all the partners of the firm, so that they can ensure that they are not holding any financial interest or other relationships mentioned in 141 of that. So there are databases, there are policies and procedures which are required to be set at the firm level. So, and this has to be driven at the culture level, at the top management level, and they should demonstrate that they value these compliances in spirit, and not only in letter but in spirit as well. Non-audit service, for example, uh, many a times non-audit partners, those who are in consulting or advisory work, they are not very conversant with the provision of the code of ethics and that. So they will not be able to, uh, evaluate whether those services are allowed service, permitted service under the Companies Act or code. So ideal way to this is provide them with the list, that if you are providing or proposing to provide any service to this bunch of clients and its related entity, you need to first go back and chat with the audit partner and get an approval that you are allowed to do this service. Audit partner in turn should not permit or reject that service merely by looking at the name of the service. For example, financial due diligence. So by name it appears that it is a permissible service, but one needs to see the exact scope of work to see whether that FDD exercise involves any judgment to be taken on management's behalf, and if yes, then it might fall into the bucket of management service. So not only audit partners should look at the nature of service, but the exact scope of work as well, and if possible, deliverable as well. This will avoid the risk of rendering prohibited non-audit service to any of the audit client or its related entities. Of course, for rotation, firm needs to have a policy on rotation of senior personnel, and that needs to be monitored on a regular basis. Moving ahead, other findings, very favorite topic of NFRA is related party transactions. All three possibilities can be there: non-identification of related party, economic substance not questioned, and non-compliance with applicable laws not evaluated. In one instance, very interesting one, there was almost 100% of the revenue was from one single party. That party was not disclosed in financial statement of 16-17. That party was not disclosed as related party. But when NFRA went 2 years back, it was disclosed as related party, and it eventually came out that it was a related party. So in case of identification of related party, that auditor relied merely on management's representation. When at the start of the audit they provide list of related parties, auditor just relied on that and didn't do any other audit procedures. And because of that he missed, and nevertheless 100% of the sale being made to that one particular party should have raised alarm in his mind and carry out more detailed procedure for that. Many a times economic substance are not questioned. Investment is made in totally unrelated business. That should alarm a question why the investment is made, and this may give a trigger that it becomes a related party. It is some way connected to the promoter and so forth. Non-compliance with applicable laws not evaluated in that. The case was, the advance given to a particular party was converted into a loan transaction, and for loan one requires approval under 177 subsection 4, but that was avoided, and therefore it was held that it was non-compliance with the applicable laws and requirement. Communication with TCWG, again, a very important and favorite topic of NAFRA. Where we miss is we do communicate with clients management and TCWG. What we not do is we fail to identify who all are forming part of TCWG. In fact, in one of the observation letter we'll discuss, it's a misnomer that people believe that audit committee is TCWG. Actually, it is not. TCWG definition comes from the standard where people who are involved in overview of the plant scope, timing of the audit, significant deficiencies, all these people are identified as TCWG. The definition comes from standard, and audit committee is a group of people which comes from section 177.4, basically section 177. So one may argue that audit committee is a subset of TCWG, but TCWG is a wider group of people, I would say. So first of all, when we communicate with TCWG under standard to demonstrate compliance, first and foremost is to identify TCWG, and it is not necessarily be only the audit committee. And the communication, what we need to do with TCWG is generally at the time of fair end of the audit when we do a audit committee presentation, and at the start of the audit where it is mandated by the standards on audit in that terms of agreement, that is our engagement letter, should be CC'd or copied to chairman of the audit committee. Generally, we find only these two documented communication with TCWG. However, during the audit process, we have been in touch with members of TCWG, but those documents remain in our mailboxes. And as we discussed earlier, NFRA will not be, considering those as audit evidence, even though you prove that those mails were before our audit report date. So first and foremost is identification of TCWG. And second is the communication was only at the fair end of the audit or at the beginning of the audit, and nothing was documented in between. Auditors argued that there were communication, but NFRA didn't consider those communication. Moving ahead, if we see audit of estimates, again a very gray area. The assumptions, basically this would be in a field of where the valuation or auditors or management experts are required. So if we see assumptions are not tested for reasonableness, work done by management experts are not challenged. For example, this was the case where the major investments was fair valued by the management expert, and the assumptions were wrong. Here this was the classic example where the fraud which was unearthed after say 1.5 years of audit report, and regulator were having benefit of hindsight, and then they challenged that why auditor didn't challenge the assumptions made by management experts while arriving at the valuation of those investments and trade receivables as well. So here the crux to the point to learn here is just don't rely on management's assumption on a plain reading of it. We might involve our internal experts, maybe from our valuation team, or maybe a colleague, a CA colleague who is expert in this field. We may hire them and do an independent verification of those estimates, because a percentage assumption movement can lead to a very material difference in the financial statements. Next observation is on the robust risk assessment. Again, a very subjective piece here, because this involves a auditor's judgment. And here what happened was the two very basic presumed fraud risk, that is management override of control, and revenue recognition were not identified as risk of material misstatement by the auditor, and that led to a huge misstatement in the financial statement. Again, a very famous NBFC case of involving a big firm, and where NFRA has concluded that the uh, identification of risk of material misstatement was not proper at the beginning, and it was not revalidated again during the course of the audit when the some anomalies were identified by the auditors. Going ahead, so here if we see uh, uh, in the possible indicators, there are certain changes in the sense that technical consultation, there should have been a policy on technical consultation. For example, in case audit estimates, maybe that particular partner is from manufacturing background and is not very privy to valuation of financial instruments. So that particular partner firm should have established a technical consultation process wherein uh, a window should have been provided to that particular partner to approach a group of people, a separate team maybe, or an expert within the firm, so that he or she could have consulted and arrived at a right observation or finding than merely relying on management experts or management representation letters on that part. So there are certain changes here. Workload management is one where uh, client tend to give us a unachievable due date, and we are under pressure to complete the engagement during that timeline, which may lead to a deteriorate in audit quality as well. Moving ahead, going concern. So evaluation of going concern has gained a greater importance, especially when in last before around 3-4 years, there is a separate reporting where one identifies material uncertainty related to going concern. We need to report it separately. The interesting case here was there were indicators of going concern uh, assumptions not being proper. For example, there were uncertainties relating to recoverability of trade receivables, defaults in payment of cash credit facilities, term loans, impairment rate, the assets, investments, basically investment in subsidiaries and associates were not tested for impairment, negative operating cash flows, long delays in completion of projects of the company, and so on and so forth. So there were indicators of going concern assumptions not been proper, but still engagement partner failed to qualify or give an adverse opinion on that. Many a times, in one of the case, it happened that despite the indicators being there, the report should have been either an adverse or a qualified adverse or a disclaimer of opinion. There was only an EOM was given. So in couple of cases, NFRA has observed that auditors do tend to take EOM view so as to not do any harm to audit client, but that is taken very severely by NAFRA. So wherever the going concern is something which is not negotiable, and in one instance, again, uh, the work paper in the name of going concern was only one checklist, which was reproduction of the entire SA 570, and there was only yes, no tick mark was mentioned. There was no evidence at all, and only one sentence was there that the actual numbers, uh, past trends and the management projections are telling with actual numbers, and therefore the going concern assumption is valid. So one needs to demonstrate the actual work done. Mere fulfilling of template or checklist will not suffice. So quite a few, around 4 to 5 NAFRA orders are there where the going concern reporting or the audit procedures around the going concern assumption was not proper. Moving ahead, audit evidence. So this is a very generic topic, and there are multiple examples of some observations which was made by NAFRA in several reports. Failure to upload SAAE, that is sufficient and appropriate audit evidence. Here, in one of the case, there was a case where substantive and analytical procedures were not performed. Uh, uh, in case of a real estate client, one very large real estate client, where the agreements for sale and transfer or the possession given, these were not documented at all. There was failure to perform analytical procedures. Material subsidiary was not consolidated, and for this, what auditor did was he gave a qualified opinion. Whereas what NAFRA believed, since it was a material subsidiary and it was not consolidated and there were other qualifications as well, the auditor should have disclaimed the opinion and not only gave the not only given would have given should have given the qualified opinion, and therefore there was an observation. So NAFRA has went ahead and challenged the auditor's judgment as well, though they have justified and given explanation on that part, but they have challenged the auditor's judgment as well. Then credit risk evaluation of trade receivable, again a long outstanding trade receivable was carried on in the financials, and that was not challenged as such by the auditor, and therefore there was an observation. The possible indicators would remain almost the same as we discussed in the previous slides. Everything is again driven by the tone at the top, and culture shift is must, I would say. Carrying on with audit documentation. Audit documentation itself was insufficient. Here the main one interesting observation was engagement partner tampered with audit documentation. And this is a very favorite subject area. One IT specialist NAFRA brings in, and his job is only to check whether there was any tampering with audit documentation after the archival date. Archival date is typically 60 days is what SQC1 provides. Generally, firm has 45 days or 30 days timeline after the report release date. That is the date on which report gets signed. After that, 45 days is given to assemble the audit file. It is not given to accumulate the new audit evidences. Please bear that in mind. So there were instances where the audit work papers were tempered after the archival period. So even after this, say 45 days or 60 days, let's say, after 60 days, once the file is archived, there is absolutely no chance that that audit work paper gets or audit file gets tempered with. And with the softwares and technology available with regulators as well, it is very easy for them to find out as to whether those work papers were tempered or not. And similar to this, there is one PCOB observation as well for an audit client, which is US listed client, where of course the regulator was PCOB, where they observed that after the sign off, after the report release date, there were 60 work papers which got added. The team was still following up with the client for audit evidences for areas like payroll, revenue, fixed assets, and there were 100 plus work paper which got added or modified after the archival period. So are you getting me? In the sense, 60 work papers were newly added between the sign off date and the archival period, and 100 more work papers were either modified or added after the archival period as well. And this was very seriously taken by PCOB, again an Indian listed company which is also listed in US, where PCOB was the regulator, and this was the observation. So please note that there is absolutely no edit after the archival period in the audit file. It is very easy to identify. Another observation was of the physical files. The sanctity with which the soft files are archived and preserved and retrievability is restricted, with the same vigor, the physical file also needs to be stored, and those are retrievable only after certain approvals within the firm, maybe only for this regulatory inspections and so on and so forth, and not for any other purposes. So second one is lapse in evaluation of writing back of liability, no evidence of audit test to confirm assumptions. Here it was a classic case where to inflate the revenue, the loan outstanding liability was written back. It was unilateral write back of liability. There was no proof or confirmation obtained from the counterparty as such, and hence the observation. Then prepare and update work paper post issuance of audit report. We discussed this. Non-provisioning of security deposit. The company has given security deposit, loan back. It was refundable security deposit. No confirmation was obtained, and no return was. I mean, the work for which the security deposit was given was over. The business purpose was over, but the deposit was not returned back, and it was in material amount, and still it was carried on as a recoverable item in the balance sheet as an asset, but this was taken as a non-compliance and an observation by NFRA. Accounting policy, an interesting case where see, accounting policy is something which is talking very practically, is which is copied from previous year, and edits are done for the current year's new policies per se. Here it was an interesting case where it was mentioned in accounting policy that valuation for AS 15 is done as on ad hoc basis and there was no actuary involved. Whereas in the notes to accounts, a proper actuary based disclosure was given. Now, here NFRA took two observations. One, the accounting policy was not in compliance with accounting standard AS 15. It was under AS regime. And second observation was the accounting policy and notes to accounts are not in sync. So, because when the auditor argued that you ignore the accounting policy piece, but the notes to accounts is properly disclosing the as per requirement of AS 15, then observation was added that policy and notes are not in sync and policy is not in compliance with accounting standard. And whenever there is something which is gone in the financial statement, be it a policy disclosure non-compliance, disclosure non-compliance, be it AS 18 related party or contingent liability, so on and so forth, and other disclosure requirement, for example, TARO requirement, MSME disclosure requirement. So when this non-compliance is there in the financial statements, the the arrow is already short. There is no coming back. For any audit documentation lapses, you may find some explanation, some argument, but those which are there in public domain, gone in financial statement, those non-compliances are non-pardonable. So one is to be very clear or very attentive while drafting the accounting policies as well. Accounting policy is a piece which is most ignored piece of financial statement, I would say. We as an auditor, we pay least attention on accounting policy, but there are observations coming in that aspect as well. I'm going ahead. There are some other findings. Failure to evaluate inventory. Here there was a case where the premises, the factory premises was seized by a government authority and no access was permitted for auditor or for any management person as well. And auditor didn't perform any physical inventory. Again, a very practical scenario where it was observed that auditor should have at least performed alternate procedures, which was not conducted, and therefore a non-compliance was observed. A failure to evaluate PPE impairment. Here there was a case where the property, plant and equipment comprised of more than 84% of the total assets of the company. Auditor had access to internal auditor's report as well. Internal auditor report didn't mention anything on the frequency of physical verification by management. Plus, and auditor documentation also didn't contain anything on whether the PPE was physically evaluated by the management. And because of this, NAFRA concluded that the procedure performed over PPE was insufficient. Failure to perform in case of again inventory, accounting policy and inventory valuation. In one interesting case, the inventory of finished goods was estimated at market price, it was written, and it was actually valued at market price. So NAFRA, so merely defining in accounting policy and valuing as such will not save any company or auditor. It has to be in compliance with accounting standard, and AS2 clearly doesn't allow any valuation of inventory on market price, and this has resulted in significant over valuation of inventory and overstatement of profit as such, and that was one of the observation. One another case was improper accounting of finished goods was reported as key audit matter, but there was no enough work documented or done in the audit file per se. Non-assessment of risk of material misstatement in trade receivable balances. Here, what happened was, in this case, contention of auditors that all sales were done to a single party, and their ledgers were reconciled. In the sense that there was only one debtor and there was ledgers were fully reconciled, and hence auditor felt that there is no need to issue or get a direct confirmation from that party, and therefore there was a non-compliance because there were discrepancies between the balances from that debtors, and one argument was that these were the opening debtors which was carrying on from the previous year, and therefore there was no need to check the existence and completeness of that debtor amount, to which it was challenged that the previous auditor indeed had qualified that year's auditor's report vis-a-vis trade receivable balances, and this auditor ignored that qualification and didn't do any specific audit procedure in that regard, and hence there was an observation from NAFRA on that piece. This is EQCR has been another most favorite topic of NAFRA, and I would say one of the less important, less weightage is given by the audit firm per se on the role of EQCR, and there are orders against EQCR partners, separate orders against EQCR partners. So first and foremost, one should be very careful when taking an role of as an EQCR, because it is as onerous as engagement partner, though the roles are separately defined. But merely becoming an EQCR, NFRA investigation might get opened for them as well. So for EQCR, all four possible types of observations are there. For listed clients, appointment of EQCR is compulsory, which was not the case in two cases of NAFRA order. EQCR led appropriate depth, focus, and follow through, in the sense the involvement of EQCR was not demonstrated in the audit file. Basically, there were only sign-offs in the important documents, let's say planning documentation sign-off, or audit report sign-off, or concluding memorandum is signed off by EQCR. But the footprints are not visible as to what exactly were his or her suggestions, how those queries were resolved. The footprints of EQCR was not there. EQCR review was quite late in a day, in the sense planning sign off was done by the engagement partner on 1st of April. EQCR sign off was done on 11th of May, and the signing date was 18th of May. So, just 5 days before the final sign off, EQCR signed off the planning of that particular client. So, timing wise, it was not proper. Completeness or the depth wise, it was not proper. In some of the cases, EQCR was not appointed at all, and non-review of essential documents, in the sense there were instances where major documents like provision of deferred tax assets, especially it requires data importance or data review in case where the DTA is created on unobserved depreciation or carry forward of losses. So those documents were not reviewed by QCR. EOM matters or qualification matters were not signed off by QCR or not reviewed by QCR. So those important documents were not signed off by QCR or reviewed by QCR, and those got caught by NAFRA in their observation. So again, a very important piece, EQCR has to be a member of ICAI. We'll discuss later in the slide where we discuss the report of those 5 firms where the quality inspection was done, where one firm's policy didn't mention that EQCR has to be the member of ICAI, and that member firm argued that while allocating EQCR, they take care of this aspect, that they allocate EQCR only. A chartered accountant is allocated a role of EQCR, but that was not heard, and that found place in the final report. That firm's policy didn't mention that EQCR has to be the ICAI member. So even while drafting the EQCR policy, care is to be taken, and after EQCR is appointed or linked to a particular engagement, care is to be taken on 2 pieces: depth and timing. The documents which are required to be reviewed one should be able to demonstrate the EQCR's involvement, and the timing. He or she should be involved throughout the audit and not at the fag end of the audit. Moving ahead, on the reporting piece, the failure to report non-consolidation of subsidiary, I think we discussed this. Instead of giving an adverse opinion, auditor gave only a qualified opinion. It was more than 50% of the overall numbers, and it was material and pervasive. So NAFRA believed that auditor should have given an adverse opinion and not only qualified one. Inappropriate reporting through TAM without sufficient appropriate audit evidence. Here, there was no evidence to justify a TAM. There was no communication with TCWG, which is actually a requirement of TAM standard, that is SS701, and then also TAM was given without any proper documentation. The one is failure to report issues relating to disclosures. So this I was telling, that if this kind of non-compliance is found, which is there evident on the face of financials, auditor has very less room for argument. Credit risk exposure, related party loans were not given on gross basis. Trade payables as per MSMED Act, full particulars of loan provided to related party. So auditors have missed these species, and therefore there was an observation, and very little argument could be provided from auditor side because it is there on the financial statement. Then in one case, utilization of IPO proceeds was not properly documented, which is requirement under RO 16, that IPO proceeds needs to be, we need to report whether IPO proceeds have been utilized for the purpose it was raised or not. Many related parties payments were made using the IPO proceeds, which was not the purpose of the IPO, and hence it was observed as a non-compliance. Failure to report non-provision of land advances. Old land advance was given. There was no control. IFC internal financial control towards this, and it should have been written off or provisioned at least uh, in the financials, which was not the case. One another case was on failure to report on non-provision of outstanding dues. Again, the same thing. IFC should have been qualified, which was not qualified. Failed to report on wrong framework adopted. Again, a very interesting case. Company actually adopted using companies at 2013, while for that particular period, it was 1956 which was applicable. A very rare kind of observation, but one instance of that as well was there. And failure to provide appropriate audit opinion, again, instead of adverse opinion, instead of disclaimer, where here again it was an interesting case, provision of doubtful debts, and in several cases advance payments were made to parties in addition to over and above the actual amount which were due to them. And investment property included a commercial building which company deployed under a company developed under a development agreement, and but management failed to provide any documentation to this piece. So three aspects were there: doubtful debts, uh, payments made in addition to the amount owed to certain parties, and investment property which was not substantiated by the audit client. And total of these three was more than 50% of the total assets of the company. And still auditor gave only the qualified opinion and not disclaimer, and hence was challenged. So right now what we discussed was from NFRA orders, individual audit files which were picked up by NFRA. And in that those files, typically they see the ISQC1 compliance as well as those individual files. Now, shortly, what we will discuss is NFRA inspection. In December 22, they selected 5 firms, 5 large firms, reasonably, and they selected certain engagement as well as they asked for all the data for compliance under SQC1. So it was a long audit, I would say. In most of the cases, there were 4 or 5 inspectors uh, physically present in auditors' premises for nearly 2 months, uh, and in December 22 continued in January as well. And their report were released. There was preliminary report which was issued for on which the audit firms gave their response, and the final report was then released by NFRA in December 23. This review included firm-wide SQC1 compliance and certain files selected by them. It was for the year end 31st March 21 typically. And engagement, their major area of focus was revenue, trade receivables, and investments. However, they also observed other areas where they found they should have gone, and so their review was not restricted only to these three line items of the financial statement, but they checked other areas as well. But their focus was mainly on these areas only. If we see these 5 final reports which came out, it ranges from let's say around 20 odd pages to 30 pages report. So thematically, all reports of all firms are same. Also, it was categorically mentioned that it is not for taking any action against any audit firm as of now, and are intended to identify areas and opportunities for improvement in the audit firm's system of quality control. And inspection reports are also not intended to be either a rating or a marketing tool for the audit firms. So those audit firms who have got lesser number of observations cannot make it as a marketing or a rating tool to their prospective or existing clients. So it was made clear. So if we see observations firm-wide or engagement-wide in during this NFRA inspection, it was similar to what we have discussed so far. However, there were certain additional or typical observations which I would like to discuss here. Is in couple of firms, they could not find documented leadership system. So there was mention of intimate these two firms leadership, but there was no mention in the SQC1 document of that firm, or manual of audit manual, or SQC1 manual of that firm. There was no identification of who all falls into this leadership system per se. Audit documentation in that main observation was cross-referencing was not there. Physical files were lying as it is, electronic file were lying as it is. There was no complete cross-referencing as to uh, work paper to which physical file work paper belongs to which work paper in the electronic format, and vice versa. And therefore, there was doubt on the sanctity or completeness of the audit documentation. Audit work paper editable after sign off. So in some of the softwares, there was possibility that audit document work paper were editable after sign off also, or after the archival date also. So there was a software uh, uh, related point which was observed by NAFRA, and they asked audit firms, concerned audit firms, to put in checks and balances to avoid this in future. In one particular instance, in one file of one large firm, there were certain documents which were found pre-signed off. In the sense, uh, assume that there was a report release, report was signed today. From today, I have 45 days as per that particular firm's policy, 45 days to document and complete my archival. During these 45 days, I have only opportunity to assemble the audit file. I can't include a new work paper. So a team member, to avoid inclusion of a new work paper, what that team member did was that particular team member inserted certain blank work paper inside the file and signed off those. So the sign off was before the report release date, but those blank work papers remained as it is in the audit file, and that got caught by NAFRA. Again, a very basic thing, but not taken care by the engagement team, I would say. Independence norms, self-review threats, non-audit service we discussed, network directly, indirectly, again we discussed. Important point here to note is non-audit service. If there is any iota of doubt, we should err on the right side of the law. NAFRA in particular is interpreting management service definition very narrowly, and need to take that till the time they change their view on that piece. Independence compliance audit. So this is basically a monitoring mechanism which normally all firms should have. For example, any firm, any partner who are holding shares need to disclose their holding on a regular basis to the firm, and firm on a periodic basis audits that particular information provided by the partner. For example, partner gave only 10 names of its or his or her investments, but on perusal of his or her a return of income where the dividend income was visible, demat statement, transaction statement, one can find out that partner was actually has actually dealt with or deal uh, bought or sold shares of 50 companies. So this is the monitoring mechanism which firm normally puts in place or should put in place to check whether the information provided by its partners and engagement team members is complete in all respects, and whether those which are not provided, whether there was any independent breach which happened. So in one of the case, the observation was uh, financial relationships were not reported fully by 35% of the partner, one executive director, 55% of directors, and 38% of the senior manager and managers. So the situation is so alarming, and believe me, it can be of a similar magnitude for smaller or mid-sized firms as well. But one needs to put in place checks and balance mechanism, monitoring mechanism to monitor this and report this and take a corrective action. So it's not like 35% of the partners have not disclosed anything. It is like 35% of the partners have at least missed reporting one security which they were holding. So though this number looks huge, but there can be less number of securities which got missed, but nevertheless it was a miss, and it leads to it puts a firm to a greater risk of non-compliance, And in this particular firm itself, after even finding out this much magnitude of non-compliance, the sample size of people getting covered in this financial interest audit reduced in the subsequent year. That was not particularly liked by NAFRA, and therefore was again mentioned in their final report. This first point is one major lapse and of a very low-hanging fruit for NAFRA for any audit observation. This is engagement independence confirmation. Independence confirmation is not obtained from all the audit team members. So the requirement is, even if a person has gone for a physical verification of inventory, let's say for a couple of days, independence confirmation is required from that particular person as well. This was a universal observation in all 5 firms, I would say, where this was missing from at least one of the engagement team members. And it is a very basic thing. Whenever person gets included in engagement team, just take that confirmation from that particular person and the job is done. But once missed, believe me, it will not be remembered until and unless some regulator comes and observes this, because it's a very small step which get missed later on. Then EQCRB mentioned the member of ICI policy didn't mention that EQCR reviewer has to be a member of ICI, and that was uh, mentioned by NAFRA in its final report of that particular audit firm. Again, one firm's policy equated audit committee as TCWG. We discussed this in our earlier discussion that audit committee is a subset of TCWG, or could be a subset of TCWG, but not TCWG as a whole. Internal inspection report. This is firm's internal inspection of their audit files. This can be while conducting audit as well as after a post facto review of the audit file. There was no rationale or criteria for selection of specific audit areas or audit partners for review in that particular firm's internal inspection policy, and that was highlighted by NAFRA that they should improve on that piece. And failure of reassessing or recategorizing audit risk, there was violation observed in one of the audit engagement audit file which was selected by NAFRA in their inspection of that audit firm per se. We are now done with NAFRA findings, orders as such. Now we will just touch upon how does QRB do their process. We have discussed initially that what remains with QRB now is only the non-NAFRA covered entities, basically large private companies, and also can be those companies which are referred by NAFRA to QRB to you do review of these files. So typically how QRB process goes is there is a quality review board, there is a QRG, which is quality review board is assisted by quality review group. So there is one technical reviewer from the bunch of technical reviewer. One reviewer is 3 options are given typically, and out of 3, one technical reviewer a firm can select. No, sorry, that is for peer review. My bad. So technical review, there is a eligibility criteria for technical reviewer as well. He or she should be as independent as uh, uh, auditor of the entity is. Uh, Technical reviewer issues preliminary report to audit firm under review. AFUR is audit firm under review. Once the response of preliminary report is given by the firm, technical reviewer may wish to drop or alter his observation and issue a final report. Final report is directly given to quality review group, and copy of that is given to AFUR as well. AFUR then submits response to final report to quality review group. Now quality review group evaluates the final report and the response to the final report and gives its suggestions or recommendations to QRB. QRB now has 4 options: forward the case to non-compliance to for evaluation whether there was non-compliance to disciplinary directorate, and then the disciplinary directorate will take it forward as per rules of 2007 disciplinary guidelines. It can issue advisory and guidelines for improvement of AFUR. So this is basically a warning given to AFUR that improve on these aspects and you are now forgiven or relieved. Uh, or they may close the case if there are no material observation, or they can recommend matters of general guidance for audit firms to be issued by the ICI. If there is some common observation which is coming again and again, QRB can advise ICI to issue a general guidance to the all audit firms as such. So these are basically 4 4 decisions which QRB may come out with. If, as I stated initially, that QRB reports are not public document, but QRB does come out with annual report which contains, overall summary and major observations which they observed during the review which they have concluded during the year. So what I have evaluated or thought of discussing here was from the annual report of 22-23, which is the latest annual report of QRB. So if we see from 12-13, since the QRB came into picture till 22-23, there were 623 cases which are closed till now by QRB. Out of these 623, in less than, or let's say approximately 6% of the cases, there was action taken. My personal belief is this might be the trigger for NAFRA's birth, because ICAI, I mean, it appears that QRB was lenient enough to take action only against 36 cases out of 623. And mind you, this 36 is the QRB's action taken. So maybe QRB would have recommended these to disciplinary directorate to take up this as a disciplinary proceeding. And out of these 36, how many were actually then penalized or sanctioned is a different statistics altogether. But QRB as such have recommended or taken action only against 36 of such instance. From the statistics of out of 623, 64 were from 22-23, and out of this action taken was only 1, advisory 50, and closed were 30. If we see observation part, they give rating as well, QRB report, which is where the significant improvements are required, not very significant improvements are required, and where generally acceptable. So as expected, majority were in either the amber category or the green category. So very interesting statistics here. If we see the observation, so observation, this diagram depicts standard on audit in wise observation. So if we see, as expected, majority of observation is coming from SQC1, and out of that, one observation is consistent, is non declaration of independence by the engagement team members. And there are multiple observations with regard to either the EQCR policy was not there, monitoring mechanism was not in place, and so on and so forth. And second most favorite uh, observation standard is audit documentation, external confirmation, SA 300, 700, and so on and so forth. So basically, all SQC1 is something which is firm wide. So we run a risk if it is observed in one case, there is a possibility that if there are three QRBs of the same firm, then the same observation might appear in all three QRB reports, because SQC1 is firm wide. So this is analysis of standard on auditing wise observation. This is again for 22-23 only. This analysis shows observation of accounting standard wise. So again, what we discussed, the most ignored piece in our financial statement audit is accounting policy, and majority observation is from that standard only. And then, of course, cash flow and other standards. These were observations from those clients which were under AS regime, accounting standard regime. This is from Ind AS regime. Here, the most number of observation came from related party disclosures, because here the disclosure standards or requirements only went on increasing, and therefore observation also increased in this particular standard. Cash flow, interestingly, cash flow and employee benefit, interestingly, is repeating or continuing, I would say, from accounting standard regime to Ind AS regime. Moving ahead, these are other observation, maybe Schedule 3 disclosure requirements, TARO requirements, Companies Act disclosure requirements. These are from those 186.4 requirement or CSR related disclosure requirements. Those were missed by some of the companies. Others will include MSME D related non-compliance, micro small finance disclosure requirements are there. Those were non-compliant or short from the expectation from which the regulator sees them. I'll not discuss these observations again. So these were the major observations in QRB. All of these we discussed at the time we discussed the NFRA orders. All are similar. Auditors use of expert, materiality, terms of engagement, estimates, related parties. So similar observations, we need to be cognizant of the basics, what we need to be aware about. Having discussed all this, where does opportunity lie for us to take corrective action? So first and foremost is the tone at the top needs to be set right. It should be visible from their behaviors, not only in letter but in spirit as well. There should be regular communication by the leadership to communicate importance of quality, ethical behavior, emphasizing firm's values and expectations to all employees. They should lead by examples. Then fostering quality-oriented internal culture. Quality should be given utmost importance. Commercial consideration should not override the importance of quality. Feedback mechanism should be put in place. Recognition and rewards for compliance or adherence to the quality norms should be put in place. Second is the fixing accountability. Whenever there is non-compliance, first of all, we management or leadership should put clear expectation from its team members, what is expected out of them on this piece, on the quality front. Performance evaluation should be done, should be robust and non-biased, and consequences of non-compliance should be communicated upfront. Maybe a sanction in policy depending on the nature of non-compliance, and the frequency at which the non-compliance occurred should be communicated and actioned upon as well, so as to give a right example to the firm at large. Providing sufficient resources, again an important piece. This doesn't include only the main headcount, but the technical resources as well. Gone are the days when we rely on only the uh, sample-based audit. It is now AI-driven audit, where the analytical procedures and so on and so forth are gaining more and more importance. So sufficient resources should be provided by the leadership or the top management for the compliance. Next piece is the ethical requirements, where we find opportunity for improvement is identification of relationships. Uh, Firms should have databases. We discussed about the financial relationship they hold or the borrowings from which they borrowed the sum, to evaluate the compliance with requirements of Section 141. Non-audit services, again, a database should be made available. Policy should be there so that non-audit partners, before proposing any non-audit service, uh, communicate or get clearance from the audit engagement partner, because we can't expect those non-audit partners to have knowledge of relevant requirements of code of ethics as well as companies act. Then on the clients and engagement acceptance considerations, we should be looking at three pieces basically: competence, capability, and whether there was resignation. In case there is resignation by predecessor auditor, whether uh, we have seen the reason for resignation or not. Competence is non-negotiable. If the client nature of industries, some specialized industry, one should have the related competence in the firm available to conduct audit. And capability includes not only the headcount and technical resources, but the time availability. For example, in April and May, if the deadline is there, one needs to see whether those particular team members will be able to allocate time to this particular client or not. It is very essential. Human resources, we discussed hire fit for role. Learning and development is must. The pace at which our regulator and standard setters are coming out with changes, be it audit trail or reporting requirements day in day out. Learning and development is must. It is a continuous process. Recently, ICI has also come out with requirement of CPE and repercussions on the individual members and firm. So it is must and ever doing. It's a continuous process basically. And recognize and reward quality, uh, again something which is very essential and basic. Engagement performance, if I say updated audit methodology, it should be dynamic. It cannot be a periodic update to the audit methodology. Any change in the requirement, any guidance note, implementation guide which comes in, immediately it should be evaluated whether it requires any change in audit methodology. And once changed, it should be disseminated to the larger team, and by learning training sessions and so on and so forth. Report and communicate uh, and audit documentation. We discussed WND principle: work not documented is work not done. It's a simple principle. Not No excuse is entertained by NAFRA in particular. Consultation policies should be put in place. It should be both ethical related consultation and technical consultation. Clear uh, guidance should be available to entire audit engagement team, whom to approach in case there is any ethical question or there is any technical question. Both again are different expertise altogether. And finally, the monitoring piece. One should have monitoring and remediation policy in place. Should have root cause analysis after as a result of monitoring process, we observed that one of the firm had 35% of the partners who were non-compliant, and similar statistics followed below partners as well. So that particular firm ideally should now do a root cause analysis, why that happened. There are different methodologies available for root cause analysis and planned actions so as to eliminate these things happening again. So again, there is a scope of improvement here. So after all these discussions, we can say confidently that solutions are definite, but implications are not. I mean, solutions are not definite, but implications are. If we fail, implications are on the firm also now. Earlier, ICI could catch hold of only members. Now the regime goes past to, and actions can be taken on the firm as well. Though it is challenged currently, but currently the rule is the implications are on the firm as well. So solutions are are not definite, but implications are. So what we have to do is, first of all, give psychological safety. Again, much of this is spoken about but not implemented. It requires a cultural shift, I would say, from top to bottom. Uh, Lack of talent. So change is reactive in the sense now regulators are becoming more uh, proactive. So we have to become proactive so as to match with the expectation of the regulator. And therefore, we need to inculcate psychological safety within our firm. Lack of talent is the main issue where people currently are facing. People are not willing to take up audit as their career option. But here we need to invest more time in training and development of people and to make our team ready for an audit. Compliance with standards, again, a non-negotiable. There is absolutely no chance which can be taken here. Increase in cost with result of all these investments, technology and in human resource. Increase in cost is inevitable. Firm can consider certain cost cutting measures, but it should not impact overall quality as such. And ultimately, it should result in increase in fee, uh, without which all these cannot be taken up. We should be able to convince our clients that the value addition which we give to them, and because of that, we should be able to command fees and not demand our fees. Uh, Again, I would like to conclude on three statements which are recently uh, made headlines. Is in the recent meet, Uday Kotak mentioned that business model of pure audit is under significant pressure, and it is getting tighter and tighter from the point of view of avoiding conflict. Again, very important statement made by as senior person as Uday Kotak. Uh, Ajay Bhushan Pandey, NAFRA chairman, stated on the scale of audit fee as well. While he mentioned that auditors are expected to display professional skepticism, but the moment they start exercising it, some management resist, and auditors are undertaking this job should be fairly compensated. So it's a bit thin that this is coming from NFRA chairman. He went on saying that he compared fees scale uh, from which the Indian auditor is getting vis-a-vis the fee scale of New York listed entities, and said that since the uh, liability or the onus is similar, he can't justify or he doesn't understand why there is so much of gap is there. So hopefully this will go in a positive direction from here on, to the clients as well, that unless we get a higher fee, we cannot be able to invest. We will not be able to invest in manpower and other technical or technological resources, and fee should increase. Uh, Again, our then president also made a statement that auditing is not an easy game, and only a serious player should only continue doing audit. With that, I think, Yogesh, I would conclude, and I'm open for question.
Share something. I was part of the conference of NFRA myself.
Yogesh, actually, I'm not able to hear you properly. Is this the case only with me, or?
Nasser, is it already better now?
Now it is much better. Yeah.
Yeah, all right. So Nasser, I was part of this conference of NFRA in Delhi, and I
Right.
echo the words which you mentioned, the words which Uday Kotak mentioned and Ajay Bhushan Pandey also mentioned. And let me also convey the message to the participants that while they all agree the difficulties which are faced by auditors, but at the same time, tone of NFRA or all the participant or speaker was very clear that auditors have to take utmost due care while discharging their professional responsibilities. So yeah, it was a very well, nice session conducted by NAFRA. I was happy to be part of that session. It was really eye opener the way NAFRA is looking at things.
Right.
So before now we can take up the questions and answer. There are a few questions on the question answer session. I will read out for you. So the
Right.
first question is whether public sector bank statutory branch auditors are covered under NAFRA.
So if so, NAFRA coverage is very specific. If it is qualifying as any of the criteria under 132, it will get covered. And for example, State Bank of India, it being a listed entity, it will get covered under NAFRA.
Right. The second question is, can NAFRA be taken to NCLAT type court for giving wrong judgments?
Well, I would have to admit that I don't know on this
Yes.
piece,
Yeah, I think,
but
yeah.
there are cases pending with Supreme Court on the certain judgment which was passed on the large audit firm, but this is typically a law-related question.
Correct. All right. The next question is, has NAFRA reviewed the audit of any government company, including CAG reports on audited government company accounts?
So from the orders which are passed, so NAFRA doesn't come out with the list of entities it has reviewed. NAFRA issues orders where it finds certain observations. So from so as I said, 74 orders are passed as on date, and I couldn't find any this government type of company in that, but actually not aware whether NAFRA covered those in its review or not. Because if there is any report which is going to be issued, if there is a clean report, then there is nothing mentioned on that.
Questions which we had on the chat box. In case any participants have any other further questions, they can put on chat box or they can raise hand also, if you permit myself.
Yeah, sure.
I think no questions are coming up, Nasser. So let me propose a hearty vote of thanks to now, sir. Now, again, thank you very much, Nasser, for ensuring this session happening at such a short notice.
My pleasure. It's okay.
And you've covered such well all the observations and what are the utmost care which as an auditors community which we need to take. With these brief words, I, on behalf of Chambers and all the participants, request everyone to applaud, to give a big round of applause to you. Thank you, Nasser, for this excellent session for the day. Thanks.
Pleasure is on mine. Thank you.
No, sorry, Nasser. Just okay, no, nothing. Sure. I thought there was some question posted, but it is about PPT. So the PPT will be posted on the Chambers website. This is for all the participants.
Right.
All right. So we close this session. Thank you so much again, Nasser. Thanks.
Thank you. Bye.